Today is Wednesday, February 18th. We are just hours away from the release of the FOMC Minutes, and the market is holding its breath. We currently have silver trading near $75.68, up nearly 3% on the day, attempting to build a base after the liquidation event we just witnessed. But the real story today isn't the price. It's the plumbing beneath the price. We are going to look at why the CME's recent margin hike created a ceiling you can't see on a normal candlestick chart, and why the smart money positioning just hit an 11-month low. Later in this video, I'm going to show you one specific data point from Sprott's physical holdings that completely contradicts the paper price crash we just saw. As always, this is education, not financial advice. Markets are broken right now. Manage your risk accordingly. If you appreciate the data-first approach, let's get into the evidence. Let's start with the crime scene. Silver fell from $120 to $70. Why? Because the margin crash we discussed last week forced a liquidation cascade. When you look at the chart, you see a vertical drop, but you have to understand the mechanics of why that happened to know if it's over. We are currently seeing a high volatility recovery. We are bouncing off the $72 support level, trading at roughly $75. But looming over this recovery is the US dollar index, or DXY. It is hovering right at 97.22. This is the pivot point. The entire macro market is waiting for the Fed minutes to decide if the dollar goes to 98.1, which would crush metals further, or if it fades back to 96.0, which would unleash them. Adding to this context, we have a signal from the institutional side. Net longs have hit an 11-month low. The tourists are gone. The Robinhood crowd that chased the price up to $120 has largely been flushed out. Now, I promised we'd talk about market plumbing. To understand why silver is struggling to break $80 despite this bounce, you have to understand maintenance margins. Most retail traders look at price charts, but professional traders look at margin requirements. When you buy a futures contract, you put up initial margin, a good faith deposit. But the exchange also sets a maintenance margin. If your account value drops below this line, you get a margin call. You have to wire cash immediately, or the brokerage sells your position at the market price, no questions asked. Recently, the CME hiked maintenance margins to 18%. This is a massive number. It means for every contract you hold, you need to keep significantly more capital in your account just to stay alive. Why does this matter today? Because high margins act like a liquidity tax. It makes it expensive to be long. The retail traders who survived the crash don't have the spare cash to meet these new requirements, so they can't buy the dip aggressively. This 18% margin requirement is the invisible ceiling capping our upside momentum right now. It forces the market to consolidate rather than V-shape recover. Let's run the numbers and look at the hard signals from the data pack. First, the futures action. The CME silver contract for March 2026 is at $75.68. We are seeing a bullish intraday rebound of nearly 3%. This is a relief rally so far, not a trend change. It is technical in nature. Traders covering shorts before the Fed news. Second, the dollar. The DXY level is 97.22. The signal here is neutral to consolidating. This is the eye of the storm. If the DXY starts moving up rapidly during the Fed minutes, that is your signal to step away from silver. Third, yields. The US 10-year yield is at 4.04%. This is actually bullish for metals. Yields are drifting lower. If yields were spiking toward 4.5%, I'd be much more bearish on silver. But right now, the bond market is behaving. There is a divergence happening between yields and the dollar. Usually they move together. Right now, they aren't. That divergence usually resolves violently, and we need to be prepared for it. Fourth, the COT report, or commitment of traders. The latest data shows non-commercial, that's the speculators. Net longs are at an 11-month low. This is a classic capitulation signal. The weak hands have sold. Historically, sustainable bottoms are formed when this number is low, not high. When everyone is bullish, you should be scared. When everyone has sold, you should be interested. Fifth, and perhaps most importantly, the PSLV holdings. Here is the kicker. While the futures price crashed 30%, the Sprott Physical Silver Trust holds approximately 216.9 million ounces. Despite the price crash, physical holdings remained steady. The physical market isn't selling. Only the paper market is. This divergence between the paper price and physical inventory is the strongest argument for a medium-term recovery. So, where do we go from here? Get your sticky notes out. Here are the hard levels. No guessing. For support, watch $72.32. That was yesterday's low. If we lose this level, the trap door opens, and we could see a flush into the 60s. Below that, the weekly close at $74.65 is our interim pivot. We need to hold that weekly close to keep the bullish structure alive. For resistance, look at $76.39. That was yesterday's high. We need to close above this to confirm a reversal. Above that, $80 is the psychological round number zone, where the 18% margin requirement really starts to hurt the bulls. We don't predict markets here, we prepare for scenarios. Here are the two paths for the next 24 hours. Scenario A is the dovish flush, which is bullish for silver. The trigger for this would be the FOMC Minutes, revealing concerns about economic growth or banking stability. If the Fed sounds worried, the dollar will likely reject the 97.20 level and fall back toward 96.50. In this scenario, silver reclaims $76 and pushes toward 80. We confirm this if we see the 10-year yield drop below 4%. Scenario B is the hawk breakout, which is bearish for silver. The trigger here is the Fed emphasizing sticky inflation and a higher for longer policy. If they do that, the DXY will break 97.50 with volume. In this case, silver gets rejected at resistance and likely retests the $72 lows. If the DXY hits 98.0, the recovery is over for the short term. If scenario B happens, there is one specific support level at $68 that dates back to the 2024 consolidation. If that breaks, the bull market structure is technically invalid. A final warning on risk. The risk here is a hawkish Fed surprise. The market is pricing in rate cuts. If the minutes sound even slightly hawkish, the algorithms will bid the dollar up instantly. Do not trade size into this event. Here's your checklist for tomorrow morning. First, check the DXY closing price. It must be below 97.50. Second, check the silver close. It needs to be above $76.39 to confirm momentum. Third, watch yields for a break below 4%. Fourth, look at open interest. Did it rise on this rally? We want to see new money entering, not just short covering. And finally, scan the headlines for any Fed whisperer articles in the Wall Street Journal tonight. We are in a cautiously bullish stance, but the ice is thin. I want to hear from you in the comments. We have three signals: the 11-month low in positioning, the steady PSLV holdings, or the 4% yield. Which one do you trust most? And a binary choice for you. Does the DXY break 98.0 this week? Yes or no? Keep your position sizing small, stay safe out there, and I'll see you in the next one.